Will a stock market crash impact house prices? What do you think? We just saw a dramatic drop in stock markets worldwide. Many woke up yesterday to the news that the Japanese stock market had crashed to one of its biggest one-day drops at 12.4%. Many feared that global stocks would follow when markets opened. But how will this all impact property prices? The FTSE 100 was down 2.4% after the opening bell, and this was the sharpest drop since July of last year. And many feared the worst for the US due to weakening job reports and fear of a recession. US stock markets also fell, and the S&P 500 was down 3%. The global trend for most markets was that there was a reduction on the day of about 2.4%, but Japan was the outlier at 12.4%. But how does this impact the property market, and more importantly, how does it impact the Irish property market? For those of you new to the channel, my name is Fleming. I work in the real estate industry for the last 20 years. I have a degree in property economics, and if you are considering buying or renting in the future, I'm working on a project called PropGen. Please check it out. We're trying to make it easier and faster for everyone buying and renting. In this video, I'm going to break down the potential impacts on how the stock market crash might impact housing. So if you're curious, stay watching. It is important to consider stock market movements when you are considering future property market trends. Back when I was in college 20 odd years ago, there was a lot of evidence and a lot of research that there was very good correlation between stock markets and property prices. And property prices would rise or fall about 6 to 9 months after a major stock market adjustment or correction. i.e., if the stock market went up, house prices generally would rise about 6 to 9 months later. If stock prices fell, house prices would generally tend to fall a few months later as well. There was good reason for this correlation. If a company was doing well and profits were up, they tended to hire more people and the economy generally improved. People felt more positive about the future and they were more inclined to buy a house and also invest in shares, pushing prices up. The opposite is also true. If company profits are down, they tend to employ less people and people start to worry about the future. They panic, which leads to selling off assets like stock. They can sell stock far faster than they can sell property, and as stock is more liquid, price volatility tends to show up far quicker in the stock market than it does in the property market. The recent drop in stock prices was due to companies reporting lower profit than expected and lower job growth in the US than expected. The actual sell-off of stock started to happen a few weeks beforehand, and there was a lot of days of negative trading leading up to Monday's negative or disastrous stock performance. When considering the recent drop in stock prices, it is important to remember what happened over the last year. Many tech companies had hyped up and even sky-high valuations. Many investors were starting to see that these growth rates were starting to fall, so they were pulling back on some of their investments. This led to many smaller investors starting to panic and sell out due to fear. If you look at the S&P 500, it's up about 15% over the last year and about 9% on year to date. So overall, it's still performing very positively in terms of the long-term trend. As properties take longer to sell and react slower than the market, it is important to consider the long-term performance of the stock market and not just a bad day. Even if the stock market started to trend downwards for the next quarter, it would take about 6 months or longer for that to show up in the housing market, all things being normal. The stock market can provide a good indicator of market confidence. One can make certain assumptions on how that confidence will play out in terms of the property market and house prices. But you can also take it one step further in terms of looking at listed companies that are involved in the real estate market, from home builders to construction manufacturers to listed REITs, etc. Reduced profits or sales for a manufacturing company that's involved in the real estate industry, such as a company like Kingspan, could suggest a slowdown in construction. A fall in share price for companies that are involved in the real estate sector can indicate a loss of confidence within that sector or a loss of confidence within the housing market, which could lead or could indicate that lower house prices are going to happen within the next few months. Companies or Irish companies like Cairn or Glenveagh or even Kingspan took a small bit of a share price hit yesterday like the rest of the world or the rest of the market. But overall, if you look at their share prices, they are trading up over the last year, and some of them considerably up over the last year. So the long-term trend for these type of companies is still very positive. Years ago, there was good correlation between the stock market, economic growth, and house prices. If the stock market fell, generally the economy was doing badly and house prices would fall too. But now perhaps there is a case to be made, and perhaps a very strong case to be made at that the stock market, particularly indexes like the S&P 500, do not reflect the overall well-being of the wider economy anymore. A lot of people would have felt that things have got harder or more difficult over the last number of years, certainly not better in many cases. Yet the stock market and indexes have raced ahead and performed extremely well. This is largely due to a large increase of capital into the markets, but also it's largely due to the fact that these indexes are now largely based on a handful of tech companies and pharmaceutical companies, which the vast majority of the population do not work for and do not see any major benefit from. Therefore, the slowdown in growth or projected profits for a handful of companies may not be felt by everyone, and they may not have a big impact on the majority of people in terms of people who are already suffering from rising costs, the inability to rent or buy a home or even afford childcare. I'm not saying the stock market crash won't be felt or won't make things worse, just the scale of that impact will be less on the general public who are already very far removed from the stock market and these companies that have dominated the indexes. People will still find it very hard to buy, rent or afford basic things. Even let's assuming that the stock market continued to fall, a US recession was confirmed, this triggered a global recession. How does this all impact house prices within Ireland? Well, first of all, we're going to have to consider a few things. There is at the moment about 156 billion cash on deposit in Ireland. That's a lot of cash. This means a lot of Irish people haven't been putting their money into the stock market and have liquid cash. There are about 2.1 million homes in the Republic of Ireland. About 50% of those don't have a mortgage and own their property outright. You might find this hard to believe in terms of that stat, but think about it. Think about who owns property at the moment. The majority of people who own property have retired or are near retiring and have already paid off their mortgage. Young people have not been able to buy at mass for the last 15 years, meaning the age profile of owners has got a lot older and most of them have paid off the majority of their mortgage. There are about 500,000 young adults living with their parents as renting or buying is just not affordable for many people. Ireland has a growing population and the government is spending billions every single year on social and affordable homes as well as giving money to housing bodies. So demand is high from multiple different sectors, and while if a recession does happen, accesses to mortgages might dry up, there's still multiple different sectors that are driving demand as well. A recession will result in less investment from the private sector into housing. US funds are drying up in terms of what they're putting into Ireland. They're already pulling out, or many are already pulling out. Some large developments in Dublin have already stopped because construction funding is drying up due to fears of a potential downturn. Some very notable developments have stopped in recent weeks and contractors have pulled off site. So supply of new housing, both in the rental sector and the private sale sector, is going to dry up. People that have homes will be very slow to sell. Unlike 2008 crash, there were many homes that were underwater with large borrowings and many of them were forced to sell. This won't be the case this time because many people own their properties without any borrowings or any repayments are quite manageable. Therefore, we won't see this forced sale off, and many people will hold on to their properties. Therefore, even fewer and fewer properties will come to the market. A global crash or a global meltdown will have an impact on the Irish house prices, but I'm not sure a price correction for a few tech companies that shifted the needle of indexes will have an impact on housing prices within Ireland at the moment. If consumer confidence does drop off dramatically and we see a massive shift or a lowering in demand from the private market, I still don't think that they're going to have a huge drop in prices because government is still spending billions every single year on housing, and that will eat up much of the supply coming onto the market. I still believe that house prices will show positive growth in 2024. It might hit double digits by the end of the year. It might slow down a little bit in Q4 of 2024, but slowdowns in Q4 are generally common most years because buyers hold off till the next year and banks are slower to lend as well. 2025 is still to be determined a little bit. Let me know what you think will happen next year. I would love to know what your thoughts are in the comments below. If you got value from this video, please like the video and consider subscribing to the channel. As always, thanks for watching.